A couple brings in a combined $350,000 a year. They live in a premium zip code, drive imported SUVs, and send their kids to elite schools. On paper, they look incredibly successful, but their mortgage, car loans, and fixed lifestyle expenses consume almost every dollar they earn. One unexpected event would trigger financial distress within months. When academic researcher Dr. Thomas Stanley spent decades studying how people actually accumulate money, he created a specific term for this exact profile. He called them under-accumulators of wealth, or UAWs. These are individuals whose spending rises so fast that their high income never translates into lasting assets. By contrast, Stanley found that the people who consistently build actual million-dollar net worths are rarely the flashy executives. They are heavily concentrated in much more unassuming roles: teachers, engineers, middle managers, and small business owners. These quiet millionaires live below their means, avoid status spending, and build wealth slowly over decades. This diagram illustrates the trap. Income is the velocity of money entering your life. Wealth is the volume of money you actually retain. A massive velocity of water means nothing if the container has a gaping hole at the bottom. The quiet millionaires have sealed containers. The UAWs have high-pressure leaks. A large paycheck creates a psychological veil. When a deposit of $15,000 or $20,000 clears every month, it generates a false sense of invincibility. The earner assumes they make too much money to bother with the discipline of a budget. Making a lot of money does not make you rich. It merely provides the cash flow to finance the psychological tricks your brain plays on you, making those cognitive errors significantly more expensive. The most common cognitive trap is lifestyle creep. When discretionary income increases, items that were once occasional luxuries slowly mutate into perceived baseline necessities. The brain quickly adapts to the higher standard of living, demanding even more spending to maintain the same level of satisfaction. This mutation happens through specific, compounding commitments. Upgrading to a larger home adds a massive mortgage. Then comes a luxury car lease, followed by private school tuition, country club memberships, and an expensive nanny. These commitments represent permanent, high-maintenance strains on the household's monthly cash flow. This line graph demonstrates the mathematical reality of lifestyle creep. The top line is your climbing income, but because the lower line, your fixed expenses, rises right along with it, the gap between the two never widens. Your retained net worth stays perfectly flat. As the net worth gap stays static, the professional loses the ability to pivot. The unmoving wall of fixed expenses makes it impossible to take a pay cut, switch careers, or step back to let a spouse stay home. They have locked themselves into a machine that demands maximum labor just to survive. This pressure is amplified by herd mentality. High earners tend to live and work around other high earners, turning lifestyle into a performance. When everyone in your circle is upgrading their homes and taking luxury vacations, objective financial analysis is replaced by the intense social pressure to participate in conspicuous consumption. They aren't buying lasting happiness. They are unknowingly financing a treadmill that speeds up every time they get a raise. This trap is particularly vicious for specialized professionals, like doctors and surgeons. While their peers enter the workforce and begin saving at 22, these specialists spend their 20s accumulating six-figure student loan debt during extended schooling and residencies. When their peak earning years finally hit in their early 30s, they fall victim to overconfidence bias. Because their new salary is so large, they assume their raw earning power gives them total control over their financial timeline. They feel they have sacrificed enough during their 20s, so they rationalize spending their new wealth on immediate gratification. They assume they can easily out-earn their late start, and they decide to delay their investments even further. This chart compares raw income against time. A massive influx of cash, starting at age 35, will almost always lose to a smaller, consistent flow of money that began compounding at 25. Time is the singular variable in wealth creation that cannot be accelerated by a larger paycheck. This psychological overconfidence is often compounded by a misunderstanding of how a high salary is actually taxed. While a $500,000 income sounds massive, it is subjected to the highest marginal rates, state taxes, and the net investment income tax. By the time these levies are subtracted, the actual capital available to save is significantly smaller than the gross number the professional is using to justify their spending. Raw income cannot rewrite the laws of compounding interest. Skipping the first 10 years of growth extracts a permanent toll on your lifetime net worth. Escaping this cycle requires treating wealth as a behavior you actively practice, rather than an income bracket you passively occupy. The first step is acknowledging that human willpower is notoriously weak against the psychological pull of lifestyle inflation. This blueprint represents one of the most effective defenses against the hedonic treadmill, the 2-year rule. The premise is entirely structural. You strictly base your current expenses on whatever your income was exactly 24 months ago. By forcing a 2-year lag on your lifestyle upgrades, you verify that a promotion is stable and permanent. It prevents you from financing a new car or a larger home based on inflated commissions that might disappear the following quarter. Next comes Save First automation. If you see the money in your checking account, cognitive biases will find a way to spend it. The only solution is to remove human decision-making entirely. You must automate contributions into 401ks, backdoor Roth IRAs, and brokerage accounts before the funds ever become visible as discretionary cash. Finally, high earners must stop trying to do this alone. Treating a complex financial life as a DIY project leads to critical gaps in tax strategy, insurance coverage, and asset allocation. Hiring an objective fiduciary advisor builds a structural wall between emotional impulses and your long-term capital. A high salary serves one functional purpose, providing the capital to buy back your own time, remove financial stress, and eventually make work optional.